Let's talk now about the compounding principle. The compounding principle explains how money grows, and if you have not been utilizing the infinite banking concept, you've been missing out on this, right? Because what the reality most people have is they start off with a load of debt. You know, the only way they have to transact business, generally speaking, is by putting it on plastic or getting in debt, you know? And we're taught that this is a normal thing. So you get in debt for your house, you get in debt for your cars, and you get in debt for, college, and you get in debt for this. And the sad thing about that is it's not like that ever ends. Most people, when they trade in a car, they don't trade it in paid off. It's got debt. So they're rolling debt into debt into debt, right? So it becomes a terrible system and that they never climb out of. So the volume of interest that the typical household pays. So somewhere in your notes, put this number down. The volume of interest. Remember, I've already shared with you, it's not the interest rate that matters. That's largely a marketing ploy, right? Your bank account doesn't understand interest rate. It understands what it translates into, which is a number, a total dollar figure. So what does matter is the volume. So somewhere in your notes, put rate versus volume. And the volume of interest that's being paid by the average household in the United States, have a guess about a number? Louder? 34.5%. That means for that family that takes home $200,000 a year, $70,000. 70 is being thrown out the window in interest charges. So one of the things that we help you do is recapture that money that was going outside to external finance companies and banking institutions. So we help that stay inside of your personal economy. How's that all work, Scott? Well, we use something called the compounding principle. Here's what it means. You set up money in an account that is a collateral-based account. So that money goes in and it stays in that account many times forever. So let's say that you're building this collateral-based account and you put in a lump sum. The very first year, remember, you can put in a lump sum the first 12 months. So let's say you put in $1 million. Lump sum. That means all $1 million shows up. Well, there's a ratio or a relationship between a lump sum and the annual funding required by the IRS. It's 5 to 1. Most people really like it to be 4 to 1, but we can make 5 to 1 happen. That means this lump sum figure must be no greater than 5 times the total figure that's being deposited each month. Okay, so to put numbers to this, 20% of that is 200,000. Okay, so if you put in a lump sum of $1 million, we can go down to 20% annual funding for 7 years, 200,000. So in this situation, $1 million goes in, then a $200,000 premium. Well, that goes into an account that starts building collateral. So when you need money, when you need to use funds, you don't take your own money. This money that you put in it, you don't take that. Instead of the money coming from your account, it comes from the insurance carrier. So listen closely to this. I hear lots of people saying, Scott, I should not have to borrow my own money. It doesn't make sense. Well, Mr. Client, respectfully, you're not. Your money is all still in that account. You're borrowing the insurance carrier's money. So the insurance carrier then lends you that at an interest rate, whatever the current rate is, and that's what that account is assessed interest at. Your account has a larger balance than your loan, and it pays a larger interest rate than the loan rate. So that difference, that margin, is what builds collateral. And so it starts to grow and grow and grow and grow and grow. Why is collateral important? Because it's the only way, y'all please listen to me, it's the only way for you to avoid the finance trap. So the finance trap essentially says that money that you pay into or money that you make currently, if you don't privatize that money, you only have two options for how do you acquire the things of life. What are those two options? You either borrow the money, like 95% of the population, put it on plastic or charge it or finance it, right? You either do that, or secondly, you pay cash. That's the only two options that most people have on how to do things. Well, when you pay cash, you give up what's called LOC, lost opportunity cost. So you give up the opportunity to earn interest on the money because you spent it. Once you spend it, it's gone, right? So we help you build collateral so you no longer spend your own money. So if you have an expenditure, you should write this number in your notes, that is greater than $2,500. Any expenditures greater than $2,500 should not come on a credit card or be placed on a credit card. They also shouldn't be paid out of your cash, because that's getting to be a significant enough number that you're going to lose that interest, and trust me, you don't want to, okay? There's a better way. Start building collateral. If you start building collateral, then you're no longer caught in the finance trap. More about that in a moment. So then if you build collateral, the next thing that happens is this miracle called compounding, right? This is what Einstein called the eighth wonder of the world. And so most people we found, even people that are very articulate, very wise, very accomplished financially and in the professional world, even those people live on the wrong side of the law of interest. What's that mean? Einstein said, wise people earn compound interest. Uninformed people pay compound interest. Okay? So what we allow you to do is to flip interest on its head. So you start receiving all the interest that would have been paid to banks or finance companies or credit card companies or department store companies or gas companies or colleges, and on and on and on and on, right? All that money that you're hemorrhaging, this 34.5%, could go right back into your account. So that money would never leave, and so you're plugging up holes in the bucket. So there are no limits to what this can grow to, and there's no limits what you can use that money for. No one will ever tell you, well, you have to fill out a form and apply for a loan. If you go to a bank or a finance company or virtually anywhere else, you have to apply to get a loan. With this, you get a loan. Okay, it's called a loan under the IRS provision. Therefore it's non-taxable, even if it's the profit, non-taxable. So you get a loan from them, but there's no limit to how many of those loans you can have or what it's used for. You can use it for anything. However, there is a priority to where I want you to consider using that money. The top priority, and I always tell our clients this, and our advisors, because we need to eat our own cooking. If your advisor's not doing this, then you should find a new advisor, okay? But unsecured debt should be eliminated, or they should be in the process of eliminating that. You should eliminate unsecured debt. What's unsecured debt? Anything that's on a credit card, any personal lines of credit, anything that's not backed by collateral is an unsecured debt. You should eliminate that first. You're getting no benefit for this. Get rid of it. It's a headwind that's hurting you financially. Secondly, you should put the money into your own business. Well, if you had the entrepreneurial spirit and enough intelligence, enough gumption, enough drive, enough courage, the guts to go out there and start your own business, my guess is there is no better place for you to put your money than in your own business, right? My guess is your business is a pretty good investment. So I would put it there next. Then next, invest it. That's right, invest it, but put money here first so you capture it as collateral. then even if the investment goes to zero, listen to me, or negative 20, or like what happened in the market in 08 and 09, and it loses 37% of its value in less than an hour. So that doesn't happen, put it here first. This is guaranteed. Then you can invest whatever you want to. If the investment tanks, you still got the guaranteed money in your account. Okay? And then lastly, use it on living expenses. Okay, so if you want to, if all these are taken care of, yes, talk with one of our advisors. They can show you how you can use this to pay your mortgage, to pay your utilities. If you can pay them annually or certainly quarterly, then you can do something like this. Quick note, there are two types of loans, two categories. An internal loan, that's one you use yourself. An external loan, that's where you lend it to someone else. So those are your two options for how you can use or access the money. Now, let me talk to you real quickly about maximum feasible net income, or gross income, sorry. This is how you fund these accounts. So you build the collateral. This is tied to collateral. So you have to capitalize your account. One of Nelson's 5 rules, don't be afraid to capitalize your account, right? So what's that look like? Well, if you're these ages, so pick your age on this chart. Let's say you're 35 years old. What the insurance company will allow is for you to get 30 times your income. What income? Your maximum feasible gross income. Okay, so let's say that for the IRS reporting you use $100,000, but you're taking advantage of every tax break that you can, legally speaking, so stay legal. You take advantage of all those tax breaks, but the real income maybe is $125,000, right? And so we would take 30 times that. Let's make the math easier. Let's say it's 200,000. So we'd take 30 times 200,000, and you would have a $6 million cap on what you can open up as far as your financing system through the insurance company. They'll let you have $6 million worth of financial or financing capacity. That's the maximum you'll be able to borrow, lend, or anything else. Now that determines the face amount of the account. This over here shows you that not only do you have to factor your age, but secondly, you have to take your income. So what we would do is take 30% of your income. So if your income, like we just said, was $200,000, 30% of that is $60,000. So if you make $200,000 a year, the maximum you can start off with is $60,000. Now, you say, Scott, why would I start off with this? Well, once you learn how this works, that any money that you don't put in your privatized account, that you're going to lose a portion of it. Why? Because it'll be back in the finance trap. What's that mean? Well, that means that you either are financing something, paying someone else interest, so you're losing 34.5% by volume. You're obviously going backwards, right? Or you pay cash. And if you're paying cash through the finance trap, you're giving up money in what the form of lost opportunity cost. We give you the chance to avoid paying interest. We also give you the opportunity to avoid losing the interest it could have gained by giving you that third option. But in that case, the money has to go through your account. And so when people understand this, let me tell you where you're going to be if we fast forward into the future by 3 months. You'll have done your first loan, and when you see you borrowed against your cash value, not from it, and that your full cash value balance remains, even though you got the check in the mail or you got the check deposited into your account, even though you have that, right? When you see that balance is full and they transferred the money to your account, give you an example. If you have $100,000 in it, and let's say you borrow $90,000 against it, in a normal banking situation, you're down to $10,000, right? With us, you're still at $100,000. Why? Because it didn't come from you, it come from the insurance company. So you're maintaining all that through there. So the beauty behind this is you're going to want to move. You're going to say, Scott, I get it now. I've done my first loan. Move me to 100%. What you'll want to do is take your entire paycheck and put it in here. And I get that. That makes sense. That's what you should want to do. And then it can be deployed from there. That way it captures all of your money inside of the privatized banking system. And once it's in there, it doesn't leak out, y'all. It's protected. So you're going to want to put 100% into it. Unfortunately, we have to start at 30. Now we will work with you to get up to about 80%. That is the compounding principle.